Hello, my name is Marilyn Osborne and I'm a CPA. And I'm a volunteer here with CPA Canada Financial Literacy. And I'm very pleased to be your host for this session, which is called the Top 5 Common Mistakes that Startups Make. Just as an aside, I also want to let you know that I'm also a small business owner, as is my husband. So I've been around the block a little bit and I've walked a mile in the shoes that you're about to walk. Now, I'm going to assume that you're either considering starting a business or already have recently. So I want to acknowledge you for the courage that that step has taken. And I also want to acknowledge the resourcefulness that you're showing by reaching out to get informed, because that will stand you in good stead. Now, we have about an hour today to spend, so I want to make this as interactive as possible. If you find that there's something you're not clear on or that I'm speaking too quickly and I can get carried away, please just feel free to put up your hand or speak up, and I'll be happy to answer your question or make sure that you get the information you're looking for. So just in terms of logistics, facilities are out the door. We've got some water over there on the desk, and just make yourselves comfortable. Okay, and I'll make sure that we save some time at the end for your questions as well. Okay, now on to the big agenda for the day. Okay, so of course we're here to talk about startup businesses, and our objective is to help you make yours a success. And what I plan to go over are the following points, as you can see up on the agenda. The first thing is the introduction, and in that I'm going to give you some fun facts about entrepreneurship in Canada. I'm also going to cover, and now these are the 5 things that's the headline of this session, the areas where people get into trouble. And the first is in determining what business structure they want to set up their business as. The second is in creating a business plan that makes sense for them. The third thing is getting organized around cash flow and financing. The fourth thing is considering things like staffing and outside expertise. And the fifth thing, of course, is taxes. And we all know that the only 2 inevitable things in life are death and taxes. So we want to make a big deal about those. And then finally, I'll ask you for your questions. Okay, any questions at this point? Okay, let's get into the fun facts. A startup is defined as a business that's been in operation for 3 years or less. Now, over half, that's 53% of new startups in Canada, are actually run by part-time entrepreneurs. So that's people that are actually holding down a job somewhere else. They're working very hard. Now, the average entrepreneur is actually starting with seed money of $5,000 or less. So it doesn't necessarily take a lot. Okay, more fun facts. 32% of startups are tech-based. No surprise these days. And then here's a big one. Out of the universe of 2.4 million businesses in Canada of all sizes, 1.3 million of those are businesses run by one person with no employees. So that's over half of the companies in Canada are run by solopreneurs. And this is interesting, you know, it's said that entrepreneurs and small businesses are the backbone of the economy, so go team. Okay, now we're into the guts of it. This is the beginning. This is the first of the 5 places that people go sideways. It's determining the type of business structure they want to organize their company as. The 3 types are, and you can see the one with the 1 cookie on it, the sole proprietorship. The next one, the partnership, has 2 cookies, and then that whole pile of cookies is corporations. So there are 3 different ways of organizing your business, and there are implications concerning tax and legal and complexity for each of those. So let's start with the 1 cookie, the sole proprietorship. Now that's the absolute easiest way to get started. It can be as simple as just deciding one day that your name is your company and using your own personal bank account. It's the least costly alternative. You don't need to hire a lawyer to file any documents. You don't have to have the separate bank account if you operate under your own name. Although it is encouraged that you keep bank records separate. And just also be aware that if you use your personal bank account, the fees and bank charges are generally lower on personal bank accounts than they are for business or corporate accounts. Okay, in terms of net income, the net income for your business for your fiscal period of 12 months gets reported on your personal income tax return, so it doesn't require a separate filing. So be aware that your fiscal period for your business must be 12 months, can't be more than that, and that usually that year end is December 31st, which jives with your own personal tax return, the T1 that you're already filing as a citizen. Finally, you can use another month, but this increases the complexity of the tax reporting, as CRA, the tax people, will require you to estimate your income from your year end to December 31st and report a notional calendar year basis. So it's some guesswork, so think carefully before you choose a different year end other than December 31st. Okay, here's a fun fact. You may have a tax advantage if you run your business as a sole proprietorship. If you happen to have losses in your business, you can net those losses against your other income on your personal tax return, any income like salary, and that might lower your overall income tax bill. Now, there is some risk. Be aware that because your business is mixed with your personal assets, if your business gets sued, if one of your clients sues you for whatever reason, they may be able to go after your personal assets. That includes your house versus a corporation, which is separate from you personally. So just be aware of that one caveat. All right, you do need to register your business, even if you are a sole proprietorship. If you want to get your business cards printed and start tomorrow and use your personal bank account, that's all great, but you have 2 phone calls to make. You must let the provincial and federal governments know about your new business. And we're provided the web link to that in our tools and resources slide, which will be shown at the end of this program, at the end of the presentation. If you operate a business under a name other than your own full name, you will need to register your business name as well. If you need to register a name, that is a provincial government issue. For example, in Ontario, it costs $60 to register your business name online, and that name becomes valid for 5 years. Now, be aware that if you use a business name other than your own name, you will need to open a bank account in that name to deposit checks to it. So there you're getting into business banking and the higher fees and charges that the bank usually applies. Note that business name registration applies to sole proprietorships, partnerships, and corporation trade names. So all 3 forms and structures of running a business need to have their business name registered. Okay, so what's the importance of a federal business number? Now, this is part of what happens when you register. This is a single account number for dealing with the federal government for taxes, for payroll, for any import and export you do, and other activities. On one final note, self-employed Canadians can now register to be eligible to receive employment insurance special benefits, which include maternity, paternal, sickness, and compassionate care benefits. Now, you can register those through Service Canada, and there is a web link provided on the Tools and Resources slide at the end of this presentation. The second form of business structure is the partnership, and that's the 2 cookie. So this partnership officially is defined as the relation that exists between persons carrying on business in common with a view to profit. Okay, so just think of it in terms of you and your best pal have decided to go into business. So you can form a partnership between 2 individuals. You can also form a partnership between you as an individual and a corporation. For example, I may, as an individual, choose to form a partnership with my husband's corporation. So that becomes a different type of partnership. Or I may, as an individual, form a partnership with my brother-in-law's trust. Or I may, as an individual who is in partnership with somebody, form a partnership with another partnership. So there's all different ways of forming a partnership, but let's just stick with the simplest one. You and an individual decide to form an individual partnership. You can set this up either verbally or with a written contract. Highly recommended that that contract is written. A partnership agreement, in addition, is strongly recommended. Honestly, you will rue the day that you didn't form the partnership agreement if anything goes sideways. The partnership agreement, among other things, will detail how profits and losses will be shared. It will also indicate what will happen on partnership dissolution. And that's going to be an important point potentially, should one of you decide to leave the partnership. Now, the way it works in terms of income, all income and losses are flowed out to partners who report their share of partnership income on their own personal tax returns, whether that's a T1 if you're in partnership with somebody as an individual, a T2 if you're in partnership with a corporation, or a T3 if it's the trust who's reporting. Now, partnerships on their own do not file an income tax return. So bear in mind, it's the recipients or the partners of the partnership that file the tax return. Okay, the tax people, Canada Revenue Agency, requires certain partnerships to file an information return. So that's different from a tax return. And that's the T5013. The tax people are replacing the requirement about the number of partners in a partnership with a requirement related to financial thresholds. And they're clarifying the requirements for the types of partners. So effective January 1st, 2011, a partnership that carries on a business in Canada or a Canadian partnership with Canadian or foreign operations or investment must file a T5013 for each fiscal period of the partnership if, at the end of the fiscal period, the partnership has an absolute value of revenues plus an absolute value of expenses of more than $2 million or has more than $5 million in assets. So that's getting into the big time. Or at any time during the fiscal period, the partnership is a tiered partnership. And what that means is it has another partnership as a partner or is itself a partner in another partnership. Or if the partnership has a corporation or a trust as a partner, or if the partnership is invested in flow-through shares of a principal business corporation that incurred Canadian resource expenses and renounced those expenses to the partnership. And in the final instance, this form is required if the Minister of Natural Revenue requests one in writing. Okay, the third form of business structure is the corporation, and we see it represented there by a great big pile of cookies. Now, you might consider that pile of cookies in terms of the potential complexity involved, the costs involved potentially, and but certain advantages that may accrue to you. So let's just go through each of those. So a corporation has a separate and distinct legal existence from its shareholder. So it's actually considered a person under the law, just like you and me. With a corporation, you add the words limited, corporation, incorporated, or their short forms like Ltd, Corp, or Inc. to your business name. Now be aware that the corporation is the more costly one to set up and administer. You can incorporate federally or provincially. You only incorporate federally if you plan to operate across Canada, throughout Canada. Federally, it costs $200 to do it online or $250 non-online. Now, be aware that a lawyer may charge $1,000 or more. A name search will be required to make sure that the name you choose is not already in use. Articles of incorporation, bylaws, and a shareholders register will be required. Administration costs, including bookkeeping and accounting, to prepare your annual financial statement and income tax returns, will be required. And remember that accounting fees will be higher for a corporation than it would be for a sole proprietorship because advice is needed regarding how to get money out of the corporation. So you may want to refer to an accountant to determine whether you're going to pull salary or dividends out of the corporation in order to compensate yourself. Now be aware that there are certain tax advantages to incorporating. The basic federal income tax rate for small business, effective January 2012, is 11%. That's 38% basic, less the 10% federal tax abatement, less another 17% small business deduction. So that's a nice low rate for a small business. Now, when combined with the provincial small business rate, the overall tax rate is about 4%, just about 4% higher. So, for example, in Ontario, the total rates, federal and Ontario together, would be 15.5%. That's 11% federal plus 4.5% Ontario. So all in, you'd be paying about 15.5% combined federal provincial tax. So this rate is on a maximum allowable business limit of $500,000. This is assuming that there are no associated corporations involved. For simplicity's sake, let's just talk about the corporation you're wanting to set up for yourself. The nice thing is these rates are lower than you would pay personally, but the money is locked into the corporation. Okay, money is extracted from the corporation by salary or dividends. Now, one other advantage is income splitting. So that means extracting money via dividends to your lower income spouse, for example. You've also got the advantage of legal protection. Now, because it's a separate entity, the assets of the corporation are the ones that are at risk, not your personal assets, so in case the business is sued. You can select a year end of any month, and remember that no matter what your corporation's year end is, you have to report any salary that you receive from that corporation on a calendar year basis. The corporation must file its own corporate income tax return, which is called the T2, and that gets filed annually within 6 months of the year end of the corporation. So that concludes the first place that people can go sideways with starting a new business. Now let's move on to the second one, where you really have to pay attention, and that's called the business plan. Now, the business plan is something you definitely need if you're getting funding for your business. Now, even if you don't require funding, even if you're going to self-finance, I highly recommend that you do a business plan. What that does is it forces you to roll up your sleeves and determine whether or not your business is viable. So the business plan will force you to research your idea, including the competition. So it's key to get feedback from potential customers at the planning stage. Will they buy what you're selling? Will they pay the price that you want to charge? And it will also force you to address whether the market is big enough for you to survive and thrive. Now on to pricing. Of course, is it competitive? Is it positioned advantageously? So your business plan research should tell you what your competitors are charging. Now, is your proposed price competitive? Is your product positioned to compete? Now, how are you going to compete? Are you going to compete on price? Are you going to compete on quality or something else? When you're thinking about your business, you want to focus on sales instead of on the perfection of the product at this stage. Do yourself a favor. Try to sell your product or service before building the perfect mousetrap. There's no sense in developing something really polished that no one is actually willing to buy. Okay, so here are some of the elements of a great business plan. Just make it concise, make it in plain English. Hey, don't want to get psyched out about this. You just want to make sure that you've done your homework. The business plan you want to contain charts, maybe some illustrations, graphs if possible. If you're going for external funding, you'll definitely want to have some sort of graphic illustration of what's happening. It just helps outsiders understand your ideas. You want to use realistic assumptions about future income and expenses. And you want to provide any detailed information about your business in the appendices. So the business plan should contain a cover page, and that's going to include all the contact details. So your company name, address, telephone, fax numbers, if you still have a fax, website URL, email address, any key company contacts. You're going to want to have, obviously, a table of contents, which is a summary of the major sections, which we're going to get to. There'll be an executive summary, and this is important because if you're getting external financing, that's the page, those are the 2 pages that people are going to look at to determine whether they're going to bother reading the rest of your plan. So you want to make sure that you've got the essence of your idea really clearly articulated in the executive summary. It's a 1 or 2 page summary of the major points of your plan. You want to have your overall goals and objectives identified. So your overall goals include any financing that you're requesting. You want to make sure that the management of the company, even if it's just you, is very clearly spelled out, identified. The experience and qualifications of the key people are so important to financiers. People who are financing a company are looking carefully at the character and experience of people who are starting up a business. That can make or break a deal. All right, What else goes into a good business plan? This is the really juicy part, all right? The marketing strategy and then the financial projections. So let's start with the marketing strategy. You want to outline what your marketing research was and your strategy for attracting customers or clients and your pricing strategy. So you want to demonstrate a lot of thinking and research behind this piece if you're going to external financiers. And you want to do it for yourself whether or not you're going to outside financing, just so you've really thought through the basics. In terms of financial projections, this is also the juicy part. So you want to summarize your startup costs and include a 5-year projection of income and expenses. That's the standard. You also want to be able to project loan repayments if that's applicable. Of course, that's very important to people who are lending you money. You're going to want to include a list of advisors. So have available the contact information for your lawyer, for your accountant, and any other advisors you may be calling upon. Okay, to conclude, in summary, you want to summarize the goals and objectives required for the financing and the reasons why this business is a good investment for outside financiers. Now, the last section will be the appendices. So this should include detailed management resumes. Again, you want to really identify and highlight the relevant experience of the people in management. Any product illustrations you have, any financial statements other than the ones you've already included, income and expense and cash flow forecasts in detail. At this point in the presentation, there's going to be a group activity. So what you're going to do is invite the participants to form themselves into groups, and you're going to be handing out the activity called Our Business Idea. And generally speaking, the intent behind this activity is for each of the groups to think of a good business idea to discuss amongst themselves, and then to pitch that idea to the rest of the group. Okay, great. So you're in your groups, you've got your activity sheets. Now, you're going to be thinking of a good business idea to discuss amongst you and develop your pitch. Now, make sure that the following elements are part of your pitch. You want to describe your product or service in 2 minutes or less. That's the objective. Now, determine why did you choose this one over other ideas? Is there really a demand for this product or service? How do you know there's a demand? Who's the target market? How will you market the product or service? And then how much will you sell it for? Okay, now we're moving on to cash flow and financing. Now recall that this is the third place that businesses can go sideways when they set up a new company. So cash flow and financing, just in a nutshell, we're going to consider what the cost is to start up, what the ongoing costs are going to be to run this business, where that money is going to come from, and then finally how to keep track of those ins and outs. So that's the big picture of the cash flow and financing. So now let's start with how to calculate your startup costs. There are two kinds. There's the assets and then the recurring costs. At this point in the presentation, you can invite participants to offer examples of what constitute assets and what constitute recurring costs. So assets, for example. What these are will depend on your business, but probably will include a computer, a printer, office furniture, perhaps incorporation costs, office or store lease costs, and often the first and last month's rent are required up front. Costs to build your website, advertising and promotion costs, insurance, licenses, and business permits. Now bear in mind, if you sell goods, you'll need to finance the goods to be sold. So you're going to have to build up an inventory, and you need money for that build-up. If you have a retail store, you're going to have to buy shelves and tables and cash registers, among other things. And note that partnerships will have additional costs, like the legal costs of drafting the partnership agreement, and corporations will have the costs of incorporating and possibly the cost of a shareholders agreement. In terms of recurring costs, these are ongoing costs, so you'll need cash to pay for monthly costs as you start up, including your office or your store rent, any salaries that you're going to pay. And also remember, you need to finance your personal expenses, since the business won't likely be generating profits for a while. And we've already talked about where the costs are going to go. Where is the money going to come from? The financing needs and your sources. So equity is one place. That means that the owners are going to put in their own money, and if it's a corporation, you buy shares. Another source is debt, for example, bank loans. Bear in mind the bank will definitely require a business plan and may ask for a guarantee on their loan, for example, from your parents, because there is a risk that you might not pay it back. You might consider applying for an interest-only line of credit. It should have a lower interest rate than credit cards. A personal credit card can be used as they are easier to get than a line of credit, but make sure you get a base card with low interest rates on any balances owing. Another form of financing is from the SR&ED grants. The Scientific Research and Experimental Development Program is a federal tax incentive program administered by the Canada Revenue Agency. Now, this program is meant to encourage Canadian businesses to conduct research and development by giving cash refunds and tax credits to organizations that do conduct that research and development. Claimants may apply for investment tax credits for expenditures such as wages, materials, machinery, equipment, and some overhead on qualifying activities. Another source of funding is crowdfunding, the newest and greatest. So the core idea of crowdfunding is that it's to generate funds for worthy projects, including entrepreneurial business ventures. It cuts out the middleman and delivers funds directly to the creator. Examples you may have heard of in the press include Indiegogo, which is a donation-based system where project owners directly receive money from willing donors based on the sales pitch. Kickstarter is another program. It has gatekeeper filters in place to keep out certain types of projects. So you want to do your research on these, but it's definitely something to look at. And then, of course, another source could be friends and family. Now, you want to be very careful about this because if you have problems paying them back, there may be a strain on the relationship. Now, how to keep your investors and lenders happy? The key is to keep them informed as to what is going on. If things are getting a little troublesome, do not keep it to yourself. A problem shared is a problem halved. You'll regret it if you keep quiet and don't keep people updated. Regular updates about activities you're undertaking and copies of annual financial statements should be shared on a regular basis. That's how to keep them happy. Okay, this section of the cash flow and financing discussion centers around how to keep track of it all. So it's so important to separate your personal and business accounts. Now, I know we said with the sole proprietorship that it was interesting that you could actually run your expenses through your personal accounts. I say that with a caveat. It's very easy to do that, but try to resist. And I know this from personal experience. Bookkeeping is so much easier if you use one account or one card 100% for business, as there is no question about whether the expenses are business and personal. And honestly, you do not want to be unraveling that at the end of the year. It's even easier if you use software. Expect to pay your year-end accountant more to prepare your financial statements and taxes if you just send them spreadsheets. I can't encourage you enough. Get yourself involved with some software. Get up to speed or get someone to teach you or even a bookkeeper to get you up to speed. Use QuickBooks or Sage 50 Accounting, which used to be called Simply Accounting. These are two of the most popular and they come highly recommended. QuickBooks also has an online version where you can access your records from any web browser. It's really not that hard to get acquainted with. In terms of monitoring your cash flow and just keeping tabs, the key is to keep your invoicing and billing process really efficient because that's where the money's going to come to pay your bills. And if the money's coming in, it keeps the headaches away. Make sure you have a standard to issue your billings as soon as you complete the work. If you leave that till later, honestly, you'll regret it. You'll want to create an accounts receivable aging report. If you're on accounting software, it'll automatically be created. The accounts receivable aging report will instantly tell you which customers' receivables are overdue. In other words, if somebody's dragging out their payment to you, you'll be able to get on the phone and get them to pay up. Remember to email invoice PDFs and accept money transfers by email to speed the whole cycle up. And you don't have to use Canada Post. Ask yourself the question, do you have enough cash reserves to get through the lean months? The key to this is to have a line of credit in place to finance lean cash flow months, or at least have enough money under the mattress to get you through the lean times. A rule of thumb here is to try and get a credit limit equal to your average accounts receivable and the value of your work in process. So any projects that you've got underway that you've spent money on that you haven't collected for, if you happen to be a service business. You want to make sure you've got a line of credit to finance that kind of work. Okay, we're now on to the fourth place, the fourth common place where startups get into trouble, and it's staffing. Now, I want you to understand that you can't do everything. You cannot. Time is infinite only if you happen to be a physicist. Seriously, staffing is key as you grow. Ask yourself, do you have the in-house expertise for sales, marketing, administration, technology, software, finance, bookkeeping, accounting? If you don't have all these skills, the business will have a low chance of success. So either try and learn the skills yourself, or you've got to hire people with the skills. If you do hire people, consider hiring them as independent consultants rather than employees. You can elect, that way you can elect to use them for shorter periods of time, and you won't have to pay them when they're not needed and when they're not busy. You want to keep as many of your costs on an as-needed basis. In terms of the experienced mentors, if you can find one, they are so important and valuable. Gaining the experience yourself is really time-consuming and can be costly if you make mistakes. It's much more efficient to find someone who's already gone up the learning curve of your selected business. You can also consider gaining experience at a company that is already successful doing what you want to do before going it alone. And now we're at the fifth place where startups can go sideways: taxes. One of the two inevitabilities of this life. There are two main types of taxes: income tax and HST or GST. Income tax is a tax on the profits of the business and differs depending on the type of business. HST is an excise tax on goods and services. Your business will need to register to charge GST/HST as soon as sales reach $30,000 in a year. What I recommend personally, going through this myself, is that even if you're making less than $30,000 in your startup year, register anyway, because that way any monies that you pay out that had HST or GST on them can be refunded to you from the government. Businesses registered for GST or HST can claim back all of that amount that they pay on expenses. These are called input tax credits. Now, what's tax deductible? This is the juicy part. You want to really pay attention here. Basically, any current expense you paid or will have to pay to earn business income. Now, this includes, and you can find this on handout form T2125. It's called a Statement of Business or Professional Activities, and you can find this online. These are all the things that you can reasonably deduct in order to create your income. This is a nice opportunity. So it includes advertising, business fees, licenses, dues, subscription, deliveries, insurance, interest, legal and accounting, meals and entertainment, your motor vehicle potentially, rent, supplies, travel, and other things. How losses work. With sole proprietorships, current year losses can offset other income, for example, salary, to reduce your tax bill. For corporations, losses are locked in that separate entity and can't offset your own personal income. Now, business losses, however, in a corporation can be carried forward and applied against future profits for 20 years and back for up to 3 years if you paid tax in the prior 3 years. Tax returns for sole proprietorships and partnerships and corporations. I'll just take you through that. In terms of a sole proprietorship, remember that it's your personal tax return, so your T1 income tax and benefit return that captures the profit or loss of your small business. In a corporation, it's a T2 corporation income tax return that will be filed. For a partnership, if it's you who are part of a partnership with another individual, you'll each be filing your T1 tax return, which will reflect your share of the income or loss from the partnership. If it's a partnership between a corporation and another corporation, or a corporation and an individual, then the corporation will file that corporation's regular T2 to reflect their share of the partnership income. And again, if it's a trust that is a party to the partnership, the trust will file their regular T3 trust income tax and information return to reflect their share of the revenue or loss in the partnership. Okay, in terms of record keeping, you have to keep your receipts for tax for some time. So I want you to be aware of this and have some safe place to keep them. Canada Revenue Agency requires you to keep all business records and supporting documents for 6 years. And note that the 6-year period starts at the end of the tax year to which the records relate. Records and supporting documents concerning long-term purchases and disposal of property, the share registry, for example, for corporations, and other documents that would have an effect on the sale or the liquidation or the wind-up of the business, those must be kept indefinitely. Read forever. Now, you can get more information if you're curious about this on Information Circular IC 78-10, which is entitled Books and Records, Retention and Destruction. Okay. Now, you're going to be really alert for this one. This is what Canada Revenue Agency looks for in an audit. So basically, they want the original receipts to back up all your expenses. So you want to be really, really careful about that because that's no fun getting an audit. So you can also keep electronic copies of receipts. The key is to be organized and make the auditor's job easier. You want to get them in there and out there. The sooner the faster, and make your life easier. Okay, with taxes, the key is to be organized. So here are some tips for you. Have a separate bank account for business. If the business expenses are mixed in with the personal, it is really time-consuming to separate them. Let me tell you from personal experience. If you can, keep a separate credit card just for business expenses. That way there are never any issues whether or not something was more personal than business. Stay up to date, stay current. Try to update costs as they are incurred rather than piling up receipts for months on end until you have to file. Believe me, I've been there. Use bookkeeping software rather than spreadsheets. If you use the software to create customer invoices and print checks to pay the business expenses, you've already done half or more of the bookkeeping automatically. Beautiful. The software also gives you instant reports like who owes you money and how long the invoice has been outstanding. That's called accounts receivable aging. And finally, keep all your paperwork. Digital copies are fine too. So for those who are tech savvy, scan all your receipts and keep them safe. 6 years is a long time. Okay, some final tips so that you start yourself off right with your new business. Start on a shoestring. Go lean. Don't commit to things before you'll know you'll need them. For example, and I've done this, our family has done this, we locked into a 2-year office lease for a business and quickly determined that we could work remotely. So this office lease was worth nothing to us and we had to sublet at a reduced rate and ended up financing this lease for 2 years when we didn't need it. It was really unfortunate and very costly. So be very, very careful before you eagerly jump into a longer term lease or any lease. If you overcommit, cash flow will become a real concern very quickly, and you want to keep it easy, easy, easy on yourself. Really, really be a miser in terms of any money that you spend, any contracts that you sign for any long-term commitment. Do your research. Often people start a business before finding out if there's a demand for their product or service. Save yourself the headache. Find out by asking potential customers in advance. Would they buy your product at your price? Keep your business finances separate from your personal finances. Tax time can be a nightmare if you have to go through bank statements and credit card statements and receipts to separate your business figures. Definitely consider a bookkeeping program like QuickBooks that now has an online web version. And try not to get into excessive debt. It has to be paid back eventually. Most small businesses use credit cards since it's tough to get approval from a bank for a small business loan. But do not abuse credit. Interest costs can add up quickly. Like today, take courses, read books. It can be hard and time-consuming, but trust me, now is the time to do it, not later when you're really busy running your business. At this point, you can stop and ask if there are any questions or if anybody has any other tips of their own to contribute. So just to recap what we've covered today, there are 3 main types of business structures: the importance of a business plan and what should be in it, cash flow and financing issues and concerns, staffing issues and getting outside expertise, how income taxes and HST and GST impact you. And finally, we have some tools and resources to show you on this next slide, so you can take this home and make sure you take a look at these as part of your research. At this stage, you might want to invite the attendees to offer any of their own suggestions for what they've learned in this session, to add to the ones that we've already described. Okay, on this slide are the tools and resources that I've been referring to throughout the presentation. Now, to help you with your plans to start a business, these are great resources. Make sure that you click through and have a look. At this point in the presentation, you want to open it up for a question and answer period. I want to thank you all for attending today. It's been a pleasure being your host, and I want to wish you every success with your new business.